Facts on debt. What you need to know. Hi there, it's Luigi, and welcome to Catapult Capitalism, your guide in making smart financial moves for your future. If you like this kind of content, make sure you hit that like button, subscribe to the channel, and click that bell notification icon so you're notified whenever we upload a new video. Alright, let's get started. Most people think debt is a risky game to play. In our childhood, we were told not to get into debt by parents, aunts, and uncles. They told us not to buy more than we could afford, not to owe anyone a dime, and so on. But there are so many ways to look at debt. Debt stands for what? Is debt a good thing? What kind of debt should I get into? And what kind of debt should I not engage into? Debt is money that one person owes another. Even so, things can get a lot more difficult quickly. In this case, the person who is borrowing could be borrowing from a business or another person. While the lender can be a public or private institution, it doesn't matter which one. To get a loan, for example, there must be an agreement and a plan for paying back the money you get, may it be in part, percentage, or in full over a set amount of time. Most of the time, people who borrow money pay it back with interest. Debt can be a useful tool for managing your money, or a burden that makes your life way more difficult. If you have debt, the best way to deal with it depends on what kind of debt you have. Secured or unsecured debt. Before a loan can be given, the borrower must put up an asset as collateral. This type of debt is called secured debt. Examples: auto loans and mortgages are two of them. Lenders can sell anything that was pledged as collateral if someone doesn't pay back the money. An unsecured debt, on the other hand, is not backed by anything. Credit card debt is a good example of this, as is having too much debt. Keep in mind, just because it's not backed by anything does not mean you'll get away with it if you don't pay back. Is debt always a bad thing, or is there such thing as good debt? In my perspective, there is no clear answer. The rationale is that a simple yes or no will only create more questions. If debt is bad, then why are the wealthiest individuals, companies, and governments in debt? But if I believe that debt is beneficial, then you may wonder why so many people and families struggle to pay off loans. A better answer would be that debt is both a good and a negative thing, depending on the type of debt. It may be argued that no debt is good debt, but for many people, borrowing money and taking on debt is the only option to finance a home. While those loans are normally justified and beneficial to the borrower, there is another side of the coin that entails uncontrolled borrowing. While these two extremes are easily distinguished, some debts are more difficult. Types of debt. Mortgages. A mortgage is a loan from a bank or other financial institution to purchase property. You can usually put down a portion of the purchase price and borrow the rest. Say you want to buy $1 million home. You can put down $400,000 and borrow up to $600,000. The bank will fund the $600,000 or 60% of the total, but this will be paid back over time. This money will have to be paid back with interest as well. That may be 30 to 40 years, and the lending company will sell your property if you fail to make these payments. If you're enjoying this video so far, make sure you smash that like button, subscribe to the channel, and hit that notification bell so you'll be notified when we upload more videos. Alright, let's get back to it. Business debt. A small business may need a loan to expand. This money can be spent on commercials, hiring employees, getting an office space, and/or warehouse rentals. Before taking this step, the organization must evaluate its market and cash flow. For example, if a company has developed a popular product and a solid management structure, this loan type may be beneficial. They only need to hire more people and rent more space. If a corporation takes on this form of debt without proper evaluation and planning, they may have issues paying it back. They risk losing their assets to the lender. Do not, and I repeat, do not get engaged in debt too much. It may limit financial flow and payment. Corporate debt. A corporation may explore borrowing money in ways that people can't. One type of corporate debt is bonds are issued when a firm promises to repay investors. For example, a corporation called SpeedX needs to upgrade its equipment to boost capacity. If SpeedX needs $1 million for this purchase, it can issue $1 million bond. Investors who purchase these bonds will receive a refund of the face value when the bond expires. Assume you bought 100 bonds and you'll get your money back in 5 years. You will get your initial money back plus interest throughout the years. Bonds act like the reverse of a loan since the corporation is the borrower and the investors are the lenders. Paper commercial. Paper commercial is a short-term type of corporate debt. It usually has a maturity of 270 days or less. Payroll, corporate meetings, accounts payable, and inventories are all funded with this sort of debt. Commercial paper is unsecured debt because it is not backed by collateral, so it's only issued by corporations with good ratings. Only a company with a good debt rating can find buyers quickly. Its face value is generally discounted. Credit card debt. The most common and the most expensive type of unsecured loan in the US. According to a new survey, American consumers are building up credit card debt at an alarming rate. However, when used properly, a credit card has many advantages over paying cash. If paying off your credit card debt has become a problem, there are a few things you can do to handle it, such as having a debt management plan or talking to a bankruptcy attorney. Car loan. So you've got a paying job, but it's quite distant from home. What'll you do if you don't have enough money to buy that car? You'll have to take out a car loan, and the payments for this will be stretched out over a set period of time. The car you acquire is the collateral in this scenario. If you don't pay your obligation, the lender has the right to seize your vehicle. Personal loan. A personal loan normally has a period of 2 to 5 years. Credit card debt can be paid off with this form of loan. It can also be used when you have a personal emergency and don't have enough money. When you need money to renovate your property, you can get a personal loan to help you out. It comes with interest rates that range from 5% to 36%. Medical debt. Medical expenses were the reason consumers were contacted by debt collectors. According to a 2017 survey conducted by the Consumer Financial Protection Bureau, medical debt can result from even the most routine doctor's visits and other health issues. If you're currently in debt from other sources, this form of loan will only make things worse. Now, you may be unable to repay your debt at times, but always remember there are steps you may take to manage the situation. You just have to do the right thing, listen to the right people, and of course, be responsible. Did you think this video was useful? If you did, smash that like button, subscribe to the channel, and click the notification bell so that you'll be updated when we upload future videos. And we've got a lot coming. Again, thanks for tuning in to Catapult Capitalism, and we'll see you next time.